Well, the dollar is down for a fourth day versus the euro. Stocks gains around the world are decreasing the dollar's appeal as a safe haven currency. David Wu says the dollar will continue to fall. He is the head of global exchange or foreign exchange strategy at Barclays Capital. Barclays, by the way, is the third biggest currency trader in the $175 trillion FX market. David joining us now from his office in London. David, thanks so much for being with us. So just how low does the dollar go and by when?
We've got basically it's 12-month euro-dollar forecast at 150. So we're talking about another, 7-8% dollar downside on a 12-month horizon. That said, I want to basically stress that, in the short term, we are looking for a bit of a dollar bounce here. We do have a euro-dollar forecast 1 month at 135 because we think some of the dollar selling has been a little bit overdone. But I think, definitely the long-term trend for the dollar is going to remain down.
What is the main difference in your argument, David? For example, Deutsche Bank put out a note yesterday saying the dollar is going to have its best year since 1981.
I think the difference is the emphasis on relative fiscal position in our forecast. What we found is that over the last 40 years, actually one of the biggest drivers, and yet the most underappreciated drivers of the dollar has been U.S. relative fiscal position compared with the rest of the world. And as we know that this year we're seeing a dramatic deterioration of the U.S. fiscal position, which is going to continue to be the case going to 2011 and in 10. And I think from that point of view, you're going to see a massive increase in the relative supply of U.S. treasuries compared with sovereign issues anywhere else in the world. So I think this question of supply and demand, if you want foreign investors to buy up all these treasury issuance, they're going to be basically willing to buy these things only at a lower price, and a lower price for the dollar as well.
Really? Because, most of the leaders that we've heard from who have made public statements seem to be continuing to support, at least again in rhetoric, buying U.S. treasuries.
I think, I think at the end of the day, action speaks for itself. I think, quite clearly there's a lot of nobody wants to be seen in public as being the first one to be selling U.S. treasuries. But again, I think the point here is, I think foreigners will be, somebody will have to basically buy these treasuries because there's a lot of issuance in the pipeline. But the question is what price? Now, I think my point here is that people will be willing to buy these things if they're the right price. The problem means a lower dollar and basically a higher U.S. basic treasury yields, which means that basically, in a nutshell, the dollar risk premium will have to go up in the next 12 months for the market to be able to digest the massive issuance in the pipeline.
So if you're selling dollar longer term, what are you buying? Are you buying yen? Are you buying euro? What looks good?
I think, I think the euro remains, an attractive currency. Not that we think that European growth is going to be out of the park here anytime soon. I think quite clearly any signs of recovery in Europe is even more tentative than the U.S. or in Asia for that matter. But we do think that given the ECB's, I think credibility as an inflation targeter, I think euro will benefit. I think some of the commodity currencies, especially countries with relatively low level indebtedness, like Australia or even for that matter Canada and Norway, are probably also going to be a good hedge against further dollar decline.
You mentioned the credibility of the ECB, but what about the fact that as a unified, they can't really control quantitative easing in the region?
I think so far, in fact, actually, I would think that they've actually done a very decent job. Just last week, they did a 12-month auction, which I thought went very well. I think, ECB obviously is a bit more long-term oriented in their thinking about monetary policy. They're more concerned about the exit strategy than the Fed of unconventional easing. So they're basically taking one step at a time. And so far, I think, European economy is doing, not that badly after all.
Okay, David Wu, we thank you as always. David Wu there from Barclays Capital.